for really, in a lot of ways, they're timeless strategies, but this year they have a specific twist to them because of the recent passage of the CARES Act. So there's been many modifications to existing charitable rules, and I hope to enlighten a little bit on what some of those rule changes are and how those might apply to you giving this year as opposed to last year or even maybe next year. The one thing I do want to say just before I get started is kind of the running joke that I have with myself is that all IRS rules they have the rule, and then there's the exception to the rule, and then there's the exception to the exception to the rule. And so I'm going to go through everything like there's just the rule with you today, because otherwise we'd be here for like 4 hours and everybody would be bored to tears. But it's really important for everybody that's listening to know that, especially if you work with an accountant or whoever is helping you with your finances, make sure you review these strategies with them to specifically apply to your circumstance. It's just really important because these are all really good ideas, but like good ideas, sometimes if they're applied wrong, you can have adverse consequences. So take the time, ask the question of your accountant or whoever is specifically familiar with your situation to verify that these ideas can work for you. Okay, with that said, we'll move on to the real part of the conversation. So of course we have Heidi and me talking today. And so, if you will, my goal is to give you a few strategies about charitable giving that fall out of the line of what has typically been conventional thinking for people with their charitable giving. So, normally people think about, hey, I have a charity that I want to support, so I'm going to give them some cash from my checking account. And that certainly works, and that's certainly a possibility. Today, I hope to leave you with a couple of ideas that will help you, possibly more from a tax perspective, to make the same net gift to the charity that does not require you to give money directly from your checking account to your charity. So if you will, my lovely analogy here, if you think about, we all have a lake checking. We all have a checking account. And that checking account for all of us is funded by various income sources, okay? Might be your Social Security, maybe it's a retirement account, brokerage account, pension, maybe you're working, wherever your income sources are coming from. And of course, that lake also has a stream that's feeding money out. And for all of us, it's some version of paying taxes, paying our monthly bills, whatever those are. And hopefully, if you're listening today, probably giving to some version of a charity or a nonprofit that you want to support. And so the very first example of what I want to share with you is a qualified charitable distribution. And again, a qualified charitable distribution is when you're able to make a gift directly from your IRA account directly to a charity. Now, the benefit of doing that is it's more tax advantageous generally for you to give a gift directly from your IRA directly to a charity than virtually any other gift in 2020. How does it work? Well, like with all great ideas and great strategies, there's always a twist. And so it's really important to know the rules. And the rules with giving money from your IRA to a charity is that that money cannot land in lake checking, okay? You see the orange line on the screen? That's your canal that you built that bypasses your checking account. The money cannot go into your checking account for you to have the benefit of a qualified charitable distribution. The benefit of a gift like this is really very simple. It's the simplest benefit that you can calculate. All of us non-accountants can all calculate this benefit. It is the amount of your gift times your tax rate. So if you give $1,000 and your state and federal tax rate is 30%, when you combine those two, the tax savings that you've avoided is $300 from a $1,000 gift, okay? So 30%, it's just that straightforward. There really is no other exception to that one rule. Now, having said that, probably somebody can find an exception. But the point is that it's a really straightforward and very powerful gift, especially this year. So that's what I'm going to talk about next. So the qualified charitable distribution, in the past, prior to 2020, was limited to those individuals who had to take what's called a required minimum distribution. And a required minimum distribution is when you have an IRA account and you're forced to take a withdrawal from that account because the IRS is making you do so. Okay, that happens. Again, the rules changed a little bit, but it could have been because you were 70 and a half or because you were 72 because the rules had recently changed and you were required to take a withdrawal out of your IRA account. That rule has effectively been suspended for 2020. So today, from now until the end of 2020, if you're over age 59 and a half, you have the opportunity to get the benefit of what has been a qualified charitable distribution, because you can take a distribution from your IRA, give it to a charity, and have the same net tax benefit as if you were over 70 and a half or over 72 and you were taking advantage of a qualified charitable distribution because you were RMD age. So again, the big takeaway is this is probably a 1 year only item. Who knows for sure, but we know that it's a benefit this year for you to take advantage of. Again, the rules still apply. You're limited to $100,000 for the total amount. And again, that really, really key rule, the money has to go from your IRA directly to the charity. It cannot go into like checking, if you think about it in those terms. Another really unique thing that now this rule adds an extra twist on to people is you might be 59 and a half, you might still have a 401k or a 403b or any kind of employer-sponsored retirement plan. You cannot take advantage of a gift to a charity from a 401k or a 403b. So you can't. But there's always the exception. The exception is you can, if you're over 59 and a half, you can take money from your 401k or 403b, whatever your employer-sponsored retirement plan is, move it to an IRA, and then give a gift from your IRA to the charity. So certainly for the folks that I've worked with in the past, if they've been in the mode of doing qualified charitable distributions in the past, we've already had their money positioned out of their employer-sponsored plan so that they could take advantage of it. But this year, you might be a little bit more under the gun. You know, you've got basically 7 months to get it figured out. And like with all institutions, things are running a little slower. So if that's something you're interested in, put that as a to-do list for you to think about, and I'd say make a decision on it sooner rather than later for your own personal circumstances. The other key tidbit for this year, again, that's relative to this year from the CARES Act, is if there was ever a time that you were thinking you wanted to make a large gift in your life, you're going to be hard pressed to find a better year from a tax perspective to do it than this year. So this year, 100% of the gifts that you give are deductible based on your total income limits. In the past, it was limited to 60%. So we don't need to go into all of the details about it other than to say and to know that if you were ever considering a large gift to a charity, this is the year to do it. And when I say large, I'm talking about more than half or up to all of, and maybe even beyond your total income that you might earn in a calendar year. And of course, maybe the logical question is, well, why? You know, I've got to live. Why would I do that? Well, people that often take advantage of these strategies do it because maybe something happened in their life that this year they have a lot of income relative to what will be their income in future years. So they might make a larger gift because maybe a business sold, maybe they had an inheritance, maybe other one-time things occur where they have an arbitrarily high income for this year, so they want to make a really high gift and this would be the year to take advantage of doing that. Okay. Okay, so the next really gift style, if you will, that I want to talk about is kind of a blend of two, which is stock and cash gifts. And I say stock and cash gifts, but really what I mean is appreciated assets. So again, if you think about that, you bought a stock 5 years ago, 10 years ago, 20 years ago, and it has risen in value. That's what I'm talking about. Anything that you've bought in the past that has risen in value significantly, and it matches the amount that you'd like to give to your charity. The other, of course, is a cash gift. We've spoken a little bit about that already. And this year, on the cash gifts, I'm just going to look to my other screen here to show you. From your checking account, this year you can give up to $300 and possibly up to $600 for married couples filing jointly without, and get a tax deduction for it without having to itemize your deductions. So that's a new thing relative to the CARES Act this year. The initial language all came out at $300. Now there's been some revision that says it might be really $600 for married couples filing jointly. That's a little bit up in the air, so be cautious of that at this early stage. But you have that ability for cash gifts that are going to be very advantageous for you this year. Now, second is, again, the stock gifts or appreciated securities. And those appreciated securities, the way you take advantage of that is, again, like the qualified charitable distribution, is giving the actual asset, maybe it's a stock, directly to your charity. Okay, so again, using an example, if I bought a stock a few years ago and I paid $5 for it, now it's worth roughly $10, and I want to give a $10 charitable gift this year, I can give that $10 of appreciated stock directly to the charity. But again, the twist here is if you sell the stock and put the cash in your checking account and then give a gift of cash to your charity, you lose the maximum tax benefit associated with that. So again, keeping our theme alive here of giving gifts without it running through your checking account, the stock has to go directly from however you own it, whether it's in a brokerage account or a direct reinvestment program, directly to the charity. Okay. Now, oftentimes people ask, well, hey, I invested in Apple. Hopefully we were all so wise to invest in Apple 10, 20 years ago. I really like Apple stock. I don't want to get rid of it. Well, no worries. Okay. Take advantage of what I like to refer to as a three-way switch. You can take, if you want to give $10 to your charity, you can take $10 from your brokerage account, give it to your charity of appreciated stock, and then you can take $10 from your checking account and move it into your brokerage account and repurchase the same security. So from an investment perspective, you've had no change at all in what your investment profile looks like. Zero. So that's a way to take advantage of that gift without impacting your investment strategy whatsoever. All you're doing in that process is dramatically lowering your tax bill. Okay. So how does the benefit work? Well, I have an example here to walk through. Again, if we use our fictitious example where I paid $5 for an investment, for a security, for a stock of some sort, it's risen $5 in value, and now it's worth $10. If I want to give that $10 to a charity, my tax savings is going to be approximately $4 or $5. Okay. If you compare that directly to a gift of cash, certainly the value is the same to the charity, but your tax savings is going to be maybe $3 in this example. And the reason is because in this example, you're able to take advantage of the income tax deduction, possibly take advantage of the income tax deduction, and also avoid paying the tax on this capital gain that occurred. So you're really working the strategy to try to take advantage of two tax savings rather than just one of a cash gift. Okay. Now, like with all of these rules, There's always an exception. There's always a twist. And so gifts of stock and gifts of appreciated security, that'd be the one that I'd put really high on my list if you're thinking about doing. Make sure you talk to a pro, or if you feel really comfortable, then certainly by all means do it. But you want to make sure that you get the full advantage of giving a gift like this, because there are some additional twists associated with it. Okay. So our next slide, my last slide, is really kind of a combination of all of these items that we've talked about. And it's a donor-advised fund. It's another method to give and receive tax benefits for gifts of appreciated securities or appreciated assets and cash. So the way a donor-advised fund works, well, first let me start with what a donor-advised fund is. A donor-advised fund is another charity. The way donor-advised funds work is they are a charity that receives funds from donors, and then they accept requests from those donors for where they should support, what charities they should support. So in this example, if I gave a gift, using this illustration, I gave a gift to my donor-advised fund of $50,000, I get the tax benefit of giving a $50,000 gift to the donor-advised fund, but then I'm able to make suggestions or grant requests to the donor-advised fund to say, hey, I'd really like to have money go to my church. I'd really like to have money go to the Red Cross. I'd really like to have money go to the United Way, or whatever my charities might be. So long as they're a qualified charity, typically, and it passes the due diligence of the donor-advised fund, then you can give those monies will go to those charities. Now, this is a great strategy if you want to group maybe 2, 3, 4, 5, 6, however many years of gifts that you might do over 1 year. Excuse me, if you might make a $10,000 gift in 1 year, you might say, boy, I want a larger tax benefit this year because it's an advantage to me. I'm going to give $50,000 this year, and then I'm going to give $0 for the next 4 years. Okay. Well, no problem. You put it in a donor-advised fund, you get the tax benefit this year, but your charities continue to receive the same amount of funds over those entire 5 years. You've just front-loaded your tax benefit. Your charity has had, or nonprofit has had, no benefit or no change in the receipt of their funds. Okay. Again, the twist with the donor-advised fund is that when you give the money to a donor-advised fund, it is irrevocable. The other great thing about a donor-advised fund that you often want to think about is a donor-advised fund can accept an apartment building. It can accept a tractor. It can accept a farm, artwork, gold, very illiquid assets. Most donor-advised funds have specific groups inside of them that handle receipt of illiquid assets. So if you've had an apartment building in your family for many years and you want to give it to a charity, a donor-advised fund can be a great mechanism to make that occur. Okay, so that's everything about the direct gifts, or about the gifts that I want to talk about. I want to just recap a little bit of the changes that are occurring from the CARES Act. I think I covered them all, but I want to make sure. So we can all look at it. Heidi, hopefully you can see that I've changed what I'm sharing. Okay.
Yes, that looks great, Jamie.
Okay, and so the temporary universal charitable deduction, that's the $300 gift that you can make, we believe $600 for married couple filing jointly, that you can give directly to a charity and deduct that from your income without itemizing your deductions. The suspension of the 60% adjusted gross income, that really is what makes that qualified charitable distribution for people age 59 and a half doable. So that's out there. And for those that have corporations, you have some increase in the amount of deductions you can give as well. And then again, a really key thing for those that are over 70 and a half or 72, your required minimum distribution has been suspended for calendar year 2020. So with that, hopefully we've got some questions, and I'd love to try to answer as many as I possibly can.
Sure. Jamie, do you want to stop sharing your screen at this point, or
Yes,
up to you? I thought that we could start with, there was one question that was asked while you were speaking earlier that
Okay.
came to Spencer. He's wondering, can QCD be taken from a Roth IRA?
It can be, but there's no tax benefit. So you can take money out of your Roth IRA and give it to a charity. There's just zero tax benefit associated with that for you because money naturally comes out of a Roth IRA without being taxed.
What about rolling over what is in your Roth IRA into a regular, like a simple IRA to then be able to do a QCD?
Well, you would be, by doing that, you would end up, I'm not even sure you could do that.
Okay.
But if you could do that, you would actually be paying tax. I don't think it would work because a Roth IRA, you don't have any tax due on those Roth IRA dollars. And if you move that, you'd have to take it out of the Roth IRA and then recontribute it to an IRA. I'm not sure that would be a possibility.
Okay. Okay. One of the other questions that had been submitted ahead of time was about, is there any tax advantage for donating from an inherited IRA?
Yes. So the same benefit holds true for inherited IRAs as I used in my examples of traditional IRAs. So you are able to continue that same qualified charitable distribution strategy with an inherited IRA.
Okay. And let's see. Another question here was, are charitable donations limited in some way by a person's adjusted gross income? And you did address that, but maybe just to further clarify.
Yeah, great question. This year, there is no limit. So it's 100% of your adjusted gross income this year. In the past, it was limited to 60% of your adjusted gross income. So in, I'll say real human conversation words, what that means is that in the past, if you had income of $100,000, if you gave $100,000 to a charity, you could only deduct 60% of it, or $60,000. This year, if you have $100,000 of income and you give a $100,000 gift, you can deduct all $100,000 of it. So that's why I was referring to, if you were ever in a situation where you wanted to make a large gift, this is the year to consider it because there's significantly larger tax savings this year than in years past.
Okay. So we have another question here actually from another land trust saying, per the information Jamie provided, a donor can donate a parcel of land to a land trust through a DAF. Can they hold that land in the DAF and distribute it to the land trust several years after putting it in the DAF? If so, when would they claim that tax benefit? The year they placed it in the DAF or when the land trust receives it?
So if I understand the question correctly, donor advised funds, each donor advised fund sets their own limitation for the types of assets that they will receive. But I'm most familiar with Charles Schwab's donor advised fund, and I know for certain virtually that they accept land, and they also accept commercial property as well. So assuming that the donor advised fund is willing to accept this parcel that you're referring to, the tax benefit occurs when the parcel goes into the donor advised fund at that very moment. But once that land of any sort is inside the donor advised fund, it's up to the donor advised fund to decide what they choose to do with it. Typically, they will turn around and sell it for fair market value, whatever the illiquid asset is. They don't work to hold those assets typically. And so I'm not sure then the second half of that individual's question would work out, because once it goes into the donor advised fund, it's turned around. The donor advised fund turns around and sells it for fair market value, kind of as soon as they practically can.
Great. I'm going to, Jamie, do you want to just share with me again your email, and I'll put it in here in case people want to reach out to you, and that is Jamie.
Yeah, so let me just pull up I'll reshare my screen here.
Mhm. And so at this point, I don't see any other questions. If anybody has any questions, please let us know. Otherwise, I'm going to be sharing here in a moment. Jamie will have his information up. And
sorry, I thought I had my email on this. I didn't. Here, let me put it in the chat bar.
sure. And we will also be, have also been recording this video today, and we will be sharing that and can send you also the link in case there's something that you want to go back and listen to or share with someone else. Otherwise, thank you for joining us today. Hopefully you have found this to be helpful information, because there have been, certainly as Jamie showed, a couple of important changes to consider given the CARES Act. And certainly, hopefully, as Jamie suggested, speak with your own tax advisor or your accountant, or reach out to Jamie if you have any other additional questions. So thank you again, everyone.
Yep, thank you so much. Thanks, Heidi.
Everyone is saying thank you, Jamie. Super informative.
Great. Hope it helps.
Great. Okay. Thank you again, everyone.